There were lots of good sporting references in this week's episode as we reflect on the career statistics of one of the all-time tennis greats, Roger Federer, and discuss the read across of his win ratio to that of investment management, in addition to learning more about an approach to constructing portfolios which can perform equally as well when the ball is swinging both ways on an opening morning at Lord's, as well as on a spinning day 5 wicket in Bangalore. We were delighted to be joined by Prashant Khemka, founder of Whiteoak Capital Management and the experienced and hugely successful investor within emerging markets. Welcome to the Investor Insights podcast, hosted by Killick & Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killick & Co YouTube channel, or by searching for Killick & Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killick.com. Killick & Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website, killick.com. In this week's episode, we were joined by Prashant Khemka, who founded Whiteoak Capital Management in 2017. Whiteoak is an investment management business which run a range of investment funds and managed accounts on behalf of clients focused on India and the broad emerging markets, and a business which has grown successfully to around 6 billion sterling of assets under management over the last 6 years. Prior to founding Whiteoak, Prashant was the CIO and lead portfolio manager of the highly successful and award-winning GS India Equity strategy at Goldman Sachs Asset Management, a company which he joined in 2000s, initially as a research analyst, but rising to become a senior portfolio manager and co-chair of the investment committee. Whiteoak is also responsible for running the investment portfolios of 2 London-listed investment companies, the £480 million market cap Ashoka India Equity Fund, ticker AIE, which IPO'd back in 2018, and the Ashoka Whiteoak Emerging Markets Trust, AWEM, which launched in the middle of last year. The Emerging Markets Trust is small in size, at only £40 million sterling, but alongside the India Fund, has managed to grow modestly through share issuance over the last 12 months, making it 2 of only a very small and rare handful of UK investment companies able to do such a thing over this period, given the prevalence of discounts across the sector. The tighter share price rating of these 2 trusts is, in our opinion, a function of 3 primary factors combined. The strong performance of the strategies is clearly helpful. However, the attractive fee structure, which charges no base management, but only a performance-related payment to better align the management team with shareholders, is combined with the annual redemption facility, enabling an exit at close to par each year. In this week's episode, we spend some time talking through investment process, more so than our usual conversations in this series, before moving on to discuss a number of topical issues related to emerging market investments. The analysis of investment process plays a critical role in our assessment and selection of active fund managers. It enables us to set expectations for both risk and return to monitor against, given any market environment. It also aids portfolio construction and provides metrics which we can track over time. Our written research publications go into far more detail on process, investment philosophy, and style. And please do get in touch if you'd like any further detail on any of the funds featured on the series so far. But the investment process devised by Prashant at Whiteoak is well considered. And given these are relatively new entrants to the London-listed investment company sector, it's well worth spending some time to learn more about, in my opinion. We hope you enjoy the discussion. Prashant, good morning. Thank you so much for sparing some time today. How are you?
Good, doing good, Gordon. Thank you. How are you?
Yeah, very well, thank you. So we've got this standard opening question that we've been asking in these discussions, and the aim of it is really to get a bit of an insight into you, really, or kind of how you go about your work. And I wondered if there's an anecdote you could share from a recent trip or a meeting, or just an insight into a research project, maybe, or even just an article or book. We've had some book recommendations in here. Anything you can share to just give us a bit of an insight into you?
Certainly. So first of all, thank you for having me here, and thank you to all the listeners. So you mentioned from recent times. I think that my favorite of late that I've been talking about externally with clients, as well as we've had a lot of discussion on. Well, when I say lot, we at least dedicated one of our investment forum sessions internally on the team on that. One is the quite famous Roger Federer tweet that he's won 54% of points in his professional career. You seen that one, Gordon?
I haven't actually, but no, yeah,
Oh,
fascinating. Yeah.
okay, yeah, but he has, which came as a bit of a surprise to me. That is only won 54% of the points. To me, his winning percentage would have been a lot higher than 54 for him to have ruled the world of tennis the way he did for over 2 decades, right? That's very insightful. And I got that as a social media forward from one of our teammates. And then I quite promptly decided, let's make it a topic of discussion. And what was it is some very good insights for world of investing. Our team was feeling quite happy that their strike rate is higher than that when measured in terms of the number of stocks they've got right over time from an alpha perspective. But the real point here is that besides the fact that even 54% can get you to the top for so many years, is that every point he has to play as if the game depended on that point. Only then can you win 54 or have a shot at winning 54 for someone like Roger Federer. And to the team, that was the key takeaway that we can't be complacent if, just like no sportsman or sportsperson can be complacent with a better than 50% strike rate. Every single point you have to, just like every single investment we have to make if as if that is the investment on which our performance depends. And then if all goes well, uh, and we get something like Federer's strike rate, then that would take us to the desired place of being amongst the top performer in the peer group. There are many other insights, but I would just leave it at this one from this tweet. But that has been something that I've thought about quite a bit over the last few months.
Yeah, no, absolutely fascinating. Yeah, yeah, and for someone who's been so consistently good as well, his career doesn't seem to have kind of ebbed and flowed. He was consistently good for someone to have a hit rate
Absolutely.
like
So
that.
that is another one of the insights.
Yeah, absolutely.
There
Yeah.
are several others.
No, thank you for that. Thank you for that. Prashant, I wondered, just to kind of frame the discussion, whether I could ask you to kind of briefly summarize, if you can, your kind of fairly distinctive approach to dissecting a kind of perspective holding for your portfolios, that opco fimco framework that you've termed. I think it will just kind of help things, and some of our listeners may not have heard it from you, certainly, kind of how you go about things. Could I ask you to kind of summarize that?
S- Certainly. No, thanks, Gordon. Some of our clients have over time asked us whether that's our secret sauce. I actually always say that, it's to continue the sporting analogy, which I do believe investing is a form of sport, a very serious form of sport. In any of the sport, be it tennis or cricket or running a marathon, these are centuries old sports. There is no silver bullet. You have to do a variety of things right in a very consistent manner, as you pointed out, Gordon, and to the highest level. And in our way of doing things, I believe our team does a lot of these in a very consistent fashion. Yes, one of the tools or one of the strengths that we have is our analytical framework, which is a bit different than the usual, but it is very much aligned with our investment philosophy. And it is basically the most fundamental uh, approach, the OPCO FinCo is basically a enhanced DCF, if you will. And I do believe, as most investors would agree, that value is nothing but the present value of future cash flows. We've just added a few enhancements to align it with our philosophy. So our philosophy, investment philosophy, very simply put, is that outsized returns are earned over time by investing in great businesses at attractive valuations. Again, no great robotic science here. Most people would agree with that. What makes a great business is one that has these attributes, key attributes, we think. Superior returns on incremental capital, one. Second, scalability. And third, management, strong management, both in terms of execution and governance. Now, these are all three of these are born out of the fundamental value equation. The value of any business is present value of future cash flows. Because to generate sustainably future cash flows, it's imperative that your returns on incremental capital be higher sustainably compared to the cost of capital. Else, there's no sustainable cash flow generation. Scalability is really about the growth of those cash flows over time. And when you have the opportunity for the first two, um, you need strong execution DNA at the organization to be able to deliver over time. And above all, or I should say, first of all, adequate governance at the firm, at the company, so that the fruits of the enterprise would be shared in fair manner, in proportionate manner with minority shareholders. Else, it may be a great business for controlling shareholders, but not for minority shareholders. Yeah. So these are the key attributes that we look for. And when you find companies that possess these attributes, it's important to value them logically and invest only if and as long as there's substantial upside to fair value. That brings us to our valuation approach and the OPCO FinCo framework. So valuation is very critical, but having said that, we don't look at P multiples or EBITDA multiples or such, but focus on first principles based approach, DCF, adapted to OPCO FinCo. In OPCO FinCo, any company, without going into details on this forum, what I'll say is any company, let's take a British company, GlaxoSmithKline Pharma, for example, uh, through our framework, we would split it into two entities for valuation or analytical purpose, a FinCo and an OPCO, Glaxo FinCo, Glaxo OPCO. FinCo is where plant and machinery and working capital would be housed, all the operating assets, that is. And the OPCO would be assigned the revenue and EBITDA. And from the EBITDA of the OPCO, it would be deemed to pay an operating lease cost for the use of plant and machinery to the FinCo, as well as a working capital financing cost to the FinCo. Yeah, so basically the operating entity, which is the OPCO, is paying the financing or leasing cost to the financing entity. After paying these costs and then paying taxes to the government, what is left is basically excess return on invested capital in the OPCO because all the cost of capital has been paid. And the present value of these cash flows, future cash flows in OPCO, represents nothing but the value of excess ROIC in the overall company, Glaxo. Whereas the FinCo represents the value of just the dump invested capital. Yeah. And the cost of capital is equated to return on capital by design for FinCo, so that growth becomes immaterial. It is valued at 1x invested capital, whereas the OPCO can be valued multiple times depending on the sustainability of the factors that in the first place enable the company to earn excess ROIC. Yeah, and the growth rate and all those. So you value these two, and the sum total of these two is the enterprise value. This provides a lot of insights into what are the sources of value and how sustainable is the excess ROIC, and how much of the value is associated with that sustainability of that excess ROIC. And then also when you rearrange the terms of this equation, which is simply put enterprise value equals value of FinCo plus value of OPCO, when you substitute the values and rearrange the terms, you also get a very handy multiple, what we call price to excess ROIC multiple for the OPCO entity. And this price to excess ROIC multiple is far more insightful than the PE multiple, because this price to excess ROIC multiple normalizes for capital intensity of the business model as well as capital structure of the balance sheet, neither of which is true for PE multiple. And hence, with PE multiples, you often get apples to lemons kind of comparisons, whereas price to excess ROIC helps to get a lot more of the apples to apples comparison within as well as across sectors. So I'll pause there. This is really a valuation framework, but also an analytical framework for us. It helps us understand the companies through this prism.
Yeah, no, absolutely. I know. I think really well worth going through. I think 'cause it is such a unique feature of the approach, and that's how you kind of are able to compare and contrast different business models across the piece. So I think it is really important. Thank you for that. Maybe just one more question on kind of process, and we'll kind of dive into some more topical questions about markets shortly. But you often talk about kind of maintaining balance within a portfolio, kind of looking to make sure stock selection is the real driver of things, not kind of
Yes.
non-stock specific issues. Could I ask you to maybe just briefly kind of describe how you approach balance within a portfolio? How are you doing that?
Absolutely. So just to zoom out a little bit, at the 50,000 feet, obviously the goal is to maximize alpha for clients, over any reasonable period of time with some degree of consistency that we talked about earlier as well. So the portfolio construction, which is one of the key pillars of portfolio management, or overall, when we talk about our investment culture, we talk about the investment philosophy, the team, the process, and then portfolio construction. So the goal or objective of portfolio construction is twofold. One, to allow for maximization of alpha over time, and second, to mitigate the volatility of that alpha in the interim. Now, the team believes that alpha, which is, let's say, what we are trying to maximize, put it in the numerator, if you will, that is predominantly, if not solely, a function of stock selection. We do not believe you can have top-down factor bets and make alpha. Yes, people can argue whether that is indeed true or not, but that is our team's belief. At least the team does not have confidence in its own top-down ability to generate alpha, nor does it have any confidence in any of its competitors' ability to generate alpha from top-down. So that's good enough for us. And then remember, a very important point in everything that I'm saying is the fact that this is a sport about relative performance. Not, but there's no such thing about absolute performance when you're managing other people's money, especially the way, the game that we play, which is long only public markets. Yeah. Again, that can be argued by people, but that's a firmly held belief. It's like any sport. It does not matter in cricket how many runs you score. What matters is whether you scored more runs than the other. Yeah. So it's all about relative performance. And so when you talk about relative performance, it has to do with alpha. And we talk about alpha, we want to maximize alpha and mitigate the volatility of alpha in the interim. So maximization of alpha through stock selection and mitigation of the volatility of alpha. Volatility of alpha can come either from stock selection, which is inherent. If you want to generate stock selection alpha, you have to take some stock selection alpha risk, volatility risk, though it has to be kept in prudent levels, which is a subject I won't go into right now because we are talking about the balanced portfolio more from factor perspective. Now, the other factor, the other aspect that introduces volatility of alpha risk and is a much bigger element in most portfolios, and that which does not contribute in our view to alpha generation over time, is the factor risk. Factor risk is just adds volatility in our view. It's a zero sum game over time. Uh, However, I don't, when I see, or let me put it this way, a bit more strongly, I think the bane of our industry is the reason for mediocrity in our industry is that a lot of investment managers or investment teams believe they can make money by factor bets, top down factor bets, either consciously or subconsciously. Then they manage the portfolios accordingly. Yeah. Whereas we want our portfolios to be balanced on these factor risks consciously, rather than going out of our way and betting on these factors. We go out of our way to try and mitigate the factor risk that may be subconsciously creeping in. It's like, if I were to give a bit of a cricketing analogy again, which I assume is sport you're familiar with, if not a fan of, it's an Indian game that British had a role to play in inventing. So that's where, if you think of at the start of the game, there's a toss. Let's say five-day game, there's a toss. Toss is very important in cricket. It may not be in tennis or football, but it's very important in cricket. A team that wins toss has a upper hand. And if the captain knew that they are going to win the toss, they may choose a different team, a somewhat different team, than if they don't know whether they're going to win or lose this toss. Yeah. Now in cricket, over centuries, people have realized and got over their superstitions that they are going to win the toss. And they know that odds of winning the toss are as good as losing the toss. And hence they put together a balanced team of batsmen and bowlers, of spinners and pacemen, and batsmen who can play well against spinners and pacemen, and so on and so forth. A balanced team so as to maximize their odds, long-term average of winning, regardless of the outcome of the toss. Yeah, they don't back the farm in one direction that we are going to win the toss. In cricket, it is well understood now, but in investing, I believe there is a lot of superstition, I believe, in a quote unquote, wherein investment teams or in fund managers or CIOs believe they can predict the coin flip and accordingly build the team here being the portfolio. Yeah. So there are CIOs and fund managers who believe they can predict whether the market is going to go up or down. In EM context, they're confident in betting that, let's say, for many years it was fashionable to bet that China is going to go up. Sometimes they're confident that LATAM is going to do well. Other times they're confident other sectors, semiconductors would do well, semi-cycle, if you will, and so on and so forth. Interest rates, currency bets, all these are equivalents of coin flips in the portfolio management context. I think over time, we have realized, in fact, very early on, we realized that these are coin flips and you can't bet um, on such superstitions. And hence, always have a balanced portfolio that maximizes the odds of success over time and mitigates the volatility in the interim. Whereas if you start betting on this macro, you lose focus on stock picking, which is where the real alpha generation opportunities is, and B, you just introduce a lot of risk that creates a lot of volatility. Sometimes, yes, you'll be just like in cricket, when you're right in your coin flip, coin toss, and you put the right, and you win, and you selected the team accordingly, you're likely to have a big success, big win. Other times, a horrible loss. But over time, it would be zero-sum game. That's what happens in many of these portfolios who bet on top-down bets, factor bets, that they sometimes would have big years and other times would lose it all. Over time, hardly generating any alpha. So volatile, inconsistent, hardly any alpha.
Yeah.
As against that, I think focusing on stock picking gives you consistent and potentially sizable alpha over time.
Yeah, no, thank you for that. Some really important points in there. I wondered if I can move on and talk about kind of two kind of really quite topical issues at the moment within markets, and then kind of hear your take on things. The first one is just this valuation and return dispersion that we've had within Asia markets, and that's between China and India, and we were talking what a couple of months after the kind of stimulus package from China, which had a kind of pretty remarkable impact, really. But India's has had such a good run, and still that valuation dispersion is still very much there. I wondered, I appreciate, given what you've just said about stock selection, I wondered if I could hear kind of your thoughts on the kind of relative attractions and how that is kind of feeding through to your portfolio.
Certainly, Ron. First of all, we might talk about some top-down views now, but please remember, we don't, we try, we actually go out of our way to make sure that our top-down views don't get reflected in the books.
Absolutely. Yeah, yeah.
So having said that caveat, put that caveat aside. Um, if you look at the return dispersion or valuation, India's valuation is quite in line with last 10 years average, its own average. Yeah. So it's not that India's valuation has run up. Uh, Market has done well because earnings growth's been very strong, but there hasn't been much of a multiple expansion, if any at all, over the last 10 years. Other markets in Asia, like Taiwan, have also done quite well. Yes. It's really, if you look at it, it's China which has done very poorly. Uh, so we can talk about the reasons for that. We think the primary reason is that there has been a regime change in China, which is structural in nature, which fixes like fiscal stimulus and all might not really, help um, help solve. When I say regime change, it is look, we've done quite a bit of work on this. We hardly do macro work, but this is very interesting, and we didn't find any published work on this, maybe because it's sensitive. But over the last 25 years, at least that we've seen, democratic country markets, equity markets, always traded a substantial premium to authoritarian regimes, and rightly so. Without going into details of this, democratic markets are, think of them as companies with superior governance compared to authoritarian regimes being equivalent to companies with poor governance. Now, people, when they think about P multiples and all that, they associate multiples to be primarily a function of growth of earnings or growth of revenues or whatever. In fact, if you delve deeper and observe closely data from across countries, across sectors within these countries, and companies within those sectors and countries, the number one determinant of P multiple is actually governance. In our assessment, governance is the key determinant. Second comes growth. People don't talk as much about governance because there's no unified consensus way of measuring governance. But just because it is not so doesn't mean it is not important. It is crucially and most important. Now, China was expected under this Western thought process that existed for many years or decades, the engagement model where you engage with China and over time it would evolve into a democracy as standards of living rise and people want more expression, and it has happened that way in other countries in Asia as well and elsewhere. Markets being a forward-looking mechanism, they were discounting that as a fact or a high probability that China would eventually evolve into a multi-party democracy, and so they were according it close to a democratic market like multiple, meaning a good governance, a country evolving into good governance. However, a couple of years ago, as we all know, Xi Jinping's term was extended for the third time, which was a break from the norm of 10-year tenure of the president. So in markets assessment now, the path to a multi-party democracy is no longer as clear. The path from a single party system to a multi-party system is a lot more dependable or foreseeable or forecastable with some degree of confidence. But the path from a single individual led government, authoritarian government, to a multi-party system, there aren't many examples of smooth or such transitions around the world, and they may entail a lot of upheaval in the process. There is a high probability of upheavals in the process,
Yeah.
and the time horizon is pushed out further out.
Yeah.
So the market has reassessed, I think, that premium that it was placing on China becoming a democratic country
Yeah.
to now valuing it closer to a authoritarian country. We don't know yet. We'll only know in hindsight whether the market is right in doing so and whether the entire discounting is already done or overdone. But I think a lot of the derating is structural and is precisely for this reason.
Yeah, no, absolutely. Yeah, no, thank you for that. I mean, the other big topic at the moment is the US and the kind of new term with Trump and the Republican clean sweep. But I wondered, I appreciate we're still kind of early days in terms of kind of actual policy announcement. We're getting kind of daily. The tweets have started, but I wondered if I could ask you just for kind of current thoughts on the impact of that on the types of businesses that you're looking at and EM in general?
Certainly. So see, even before the Trump election or outcome, I've been saying, and it is consistent with that viewpoint, that we can look at the first term
Yeah.
as a guide. And if you do that, I think, regardless of how Trump turns out for humanity, I think it is reasonable to expect that Trump would be good for the American markets, equity markets. And the American market is such a large market in global context that it should then have a similar uplifting force on markets globally. Within that, there will be relative winners and losers. Yeah. And some again going by the first term, it's very likely China would be at receiving end, and some other countries would be at receiving end of Trump's policies, and that would indirectly benefit other countries like India, where the whole China plus one phenomena really truly began in 2015, from the day Trump went on the campaign for primaries, Republican primaries, and when he started spewing all this rhetoric against China and trade with China, that's when corporate leaders around the world sat up and took note and started worrying about supply chain diversification, because what if this guy gets elected and they'll have to still run their businesses? So that benefits other countries, and India is one of the bigger beneficiaries of that. So if Trump were to play by the same book as he did in the first term, I think these are some of the reasonable expectations to have this time around as well, where it'll be harsh on China and some other, I mean, some puts and takes for Mexico, because Mexico also benefits because of near shoring might bring some of those jobs from China and manufacturing from China closer to Mexico. And India, I do see as a beneficiary. But all these are small elements. These are not make or break for EM overall or for countries like China or India. There's an additional small negative, I would say, for China, and an additional small positive for India. There are much bigger forces at play in China and in India, independent of Trump. We already talked about, you know, the Chinese case, and in India, India has its own set of strengths or otherwise that are far more dominant forces than Trump.
Yeah, no, absolutely. Yeah, no, some important points in there. Thank you. Uh, back to kind of stock specific issues, if I can. And one kind of, I mean, since you've launched the emerging markets trust, you kind of commonly invested in a kind of small portion, but still kind of noteworthy in developed market listed companies, albeit those are obviously generating kind of a high proportion of revenues from emerging markets. But that has been a kind of an important component of the portfolio. Could I ask you to just explain the rationale there, and maybe an example?
Certainly. So you're right about mid-teens percentage of our portfolio weight is in developed market companies. Now, most, if not all, developed market companies that are in the portfolio, they possess these three attributes, or combination of these three attributes to some extent or the other. One is that they must derive majority of value from emerging markets. I'm very careful in saying value. It's not revenues or cost, but majority of value from emerging markets. Now, it doesn't have to be directly. So there are some exceptions. Without going into details, there could be some exceptions to this rule. But by and large, majority of value coming from emerging markets. Second, there must be high alpha opportunities. Because there are hundreds of companies in developed world who derive majority value from EM. We don't own anywhere near all of them. We are, so in fact, more selective in developed world than even in EM, if you will. And so majority of value coming from EM and high alpha opportunity. And third, they must mitigate some factor risk in the portfolio. So ideal developed world companies which possess all these attributes, some of them in the portfolio may possess only two of these three. So majority of value coming from EM, high alpha opportunity, and also mitigating some factor risk. So a lot of the developed world companies we own in the portfolio are companies that mitigate the underweight China risk, as an example, or same other authoritarian regimes risk, because authoritarian regimes in the portfolio are somewhat underweight, about mid-teens percent, low to mid-teens percent underweight. And it's not because we believe these markets would underperform. For example, we'd never have believed, though it might have been the case in the past that China has underperformed, we've never believed, looking forward, that these markets would underperform. It's just that in authoritarian regimes, just like we are, we have higher allocation in better governed companies compared to poorly governed companies. Again, it's not our belief that poorly governed companies will underperform. We have lower allocation in SOEs. Again, it's not our expectation that SOEs would underperform. It's just that alpha generation in poorly governed segments of the market is lower. The return might be the same as a basket, but to identify winners is more difficult, inherently unpredictable, because there's a greater element of coin flip in these companies than, skill, if you will. And so we allocate more capital to alpha rich segments of the market, which is better governed segments of the market, and then by extension also more democratic countries. But that creates a certain factor risk if you are underweight by material degree, sizable degree, all these authoritarian regimes. And to mitigate that risk, and still get exposure to their economies, we do identify these high alpha developed market opportunities, which give us the economic exposure without the governance risk.
Yeah. Yeah, no, that's important. Yeah, thank you. Prashant, my final question is another the standard question that we ask, and it asks the speaker to kind of highlight one particular area that is kind of highest conviction at the moment. And I wondered if I was to ask you that, what would you choose with that respect?
Very interesting. So if I piece together everything that I've said so far, there is no macro view on a country doing better than the other. There's also no market cap view in aggregate of small caps doing better than large caps, or currency view, or nothing of that sort. Uh, our highest conviction is always where we see highest alpha potential, and which tends to always be, in the smaller and mid cap segment. Because small and mid cap, one thing that is structurally true and has not changed in history and unlikely to change going forward, at least in foreseeable future, in our lifetimes, is that small and mid caps are more inefficient segments of the market. That's true in developed world as well, including in US, and certainly true in emerging markets. So we always tend to have a structurally higher allocation to small and mid caps, not because we believe that as a basket they're going to outperform in the market, but we believe they are more inefficient segments of the market, and our investment team can identify the big winners, or the winners, and avoid the losers better in this segment of the market because of the greater inefficiency in the market, and in the process generate higher alpha. And then as the game is all about alpha, our conviction is always higher of alpha generation in mid and small cap segments. Though you can still extract meaningful alpha in large caps, particularly in EM, large caps are also inefficient, more so than the developed world. But obviously, mid and small are much more so.
Yeah, yeah. No, I'm glad we finished on the kind of smaller element of the portfolio, because that's another kind of key differentiator to what you're doing. But Prashant, it's always fascinating to chat to you, and thank you so much for sparing some time today.
My great pleasure. Thank you, Gordon, for having me here again. Thank you so much. And thank you, all the listeners.
Thank you for listening to the Investor Insights podcast, hosted by Killick & Co. You can get in contact using our podcast email address, investorinsights@killick.com. For more information on any of the topics discussed, or for further details on the services offered by Killick & Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killick & Co. is authorised and regulated by the Financial Conduct Authority, the FCA.